All right, so we're going to talk about IFRS 15, as you say, Pascal, the standard nobody wants to talk about. The idea behind this session, I think, is just to give you a very quick feel for what is in IFRS 15. And hopefully through the process of giving you that quick feel on IFRS 15, just give you an idea of where some of the complexities might arise for banks, for insurance companies, and for others. Primary focus here, I think, is for the banking sector. We've got an example that runs through these slides that specifically doesn't refer to the banking sector, but as I work through the example, I'll give you a couple of ideas of how I think banking and insurance, and for that matter related industries, might actually be affected by it. There are a couple of important things about the revenue standard. The first thing is, this is a joint standard with the FASB. So this is not just a IFRS standard. We've actually jointly made almost all the decisions with the FASB. And that means that it's an international standard. It also has one significant downside of having an international standard, and that might be relevant to those of you who are in capital market regulation rather than pure banking regulation. But it might kick back a little bit into banks, and I'll give you one example a bit later. Because we have a joint standard, because we've used the same words in IFRS and FASB, and because FASB has generally in the past had a history of being a more rules-based standard setter, there's a strong likelihood that over the process of time, the combined standard that we have will develop a little bit of a US flavor. The US will issue interpretations on particular things, and those interpretations will flow backwards through the process. After tea, we'll talk about IFRS 9 impairment, and you'll see there that we've kept it at a much more principle-based level. We'll talk about why and why that makes sense. In IFRS 15, we've tried to keep it at a principle-based level, but we suspect that more guidance will develop, as I say, because of the FASB connection. And we're already seeing that, and Pascal mentioned the fact that we've actually had to delay implementation, or we've recommended delaying implementation of the standard by a year. In part, that relates to this a need for additional guidance in the US environment. So we've changed it to January 2018. That's when it comes in. It also means then, from the purposes of banks, or for the purposes of banks that are applying this and insurance companies applying it, the starting date is simultaneous with the starting date of IFRS 9. So you'll be starting both standards at the same time. There's some advantages to that. There's also disadvantages to it. And it's this point that we mentioned earlier, that if you're too focused on 9, you may forget about 15, and 15 might actually surprise you at the last minute. They're both at the same time, both part of the same process, and the one might catch up with you because you focused on the other one. We're going to the timeline. IFRS 15 has got a very broad scope. Essentially, it deals in totality with all contracts that are entered into between a company and its customers, so contracts with customers. The only exceptions to that are lease contracts. So if you've got a lease, you apply the lease standard. Insurance contracts, you apply the insurance standard. Financial instruments, as we've just discussed, but that dividing line becomes slightly more difficult, and we'll talk about that later. And then non-monetary exchanges. What is a non-monetary exchange? A non-monetary exchange is simply when instead of receiving cash from somebody, I receive a very similar good in return. And that non-monetary exchange occurs between two parties who are essentially in the same line of business. Those are then excluded. Why? Because somebody who's in the same line of business engaging in a non-monetary exchange is probably not actually a customer. What they are is simply a fellow merchandiser, and you're entering into a transaction to facilitate sales. The way we like to think about the revenue recognition process is as a 5-step process. Now, unfortunately, the way we write standards doesn't actually bring that out. You don't get that from sitting down and reading the standard. But starting with this framework, and anybody who's going to actually apply the standard, this is the best place to start. Starting with this framework allows you to walk through the standard in a very logical manner. It allows you to actually go through the process and understand how the process should work in a revenue recognition environment following a very simple step-by-step process. And I'll get straight into the steps I think is the easiest. By the way, it's probably a good time for me to say, I think as we go through this, and as we go through, in fact, the course of the next 2 days, if at any point in time you want to stop me and ask me questions, please do that. It's generally easier to answer a question as we go than to come back to questions at the end of a process. Most of the slides we've got here, and that occurs for almost all the sessions we'll be hosting over the next 2 days, are essentially slides that are set up in such a way that if I don't finish the slideshow, it's not a tragedy. So if we have lots of questions and we don't finish the slides, that's great. You've got the information in front of you. If you've got no questions and we go all the way through, that's fine. But then I'm going to get bored listening to my own voice. So having you guys ask me questions also helps in terms of the process. All right. So the first part of the process is a fairly logical one. Identify the contract. Identify whether, in fact, you have a contract with a customer. The existence of the contract, it must meet specified criteria. An example of what those criteria are is it needs to be a contract that both parties intend to fulfill. So if I write a contract at the year end and reverse the contract the day after year end, and it's obvious from the terms and conditions of the contract that the contract was probably not going to happen, then that's not a real contract. If the terms of the contract are such that you can see that it's not a real contract, it's not a real contract. So you're looking for those sorts of things. You're looking for evidence that the underlying terms are not real. Now, one classic example of this, I don't know if anybody's ever been to one of the presentations of timeshare. Timeshare, what happens is you get this wonderful invitation that you're going to get a free gift if you come along and just watch a video. And then you get this real hard sale that happens. Okay, and a lot of people end up signing the piece of paper. And then generally, legislation in most countries says that you've got 7 days in which to decide whether or not you actually want to keep the contract or whether you want to back out of it. In most industries, and South Africa is a good example, timeshare is sold exactly like the, timeshare, for those who don't know, is you get a 1 week stay in somebody's villa, somewhere or other. Very hard sell product. In South Africa, you've got 7 days to reverse it. 90% of time sale contracts are reversed within that 7-day process. So there's an assumption by the seller that it's not going to really happen. There's not really an assumption from the buyer, but the buyer more often than not reverses it. In that circumstance, arguably, you don't have a commercial contract until the 7 days have expired. Okay. Likewise, in the US, medical products are sold at a particular price. So your price of $100 on something. But if I have medical insurance in the US, the price is actually determined by the medical insurer. And very often that price is a fraction of the original cost. It'll be 10%. So essentially what happens with medical products in the US, they try to target the guys without insurance. So I've signed a contract for $100. But the reality is the contract is probably for $10. And so again, you need to consider the reality of the contract. You need to consider the circumstances in which a particular contract happens. The one really important thing about that first requirement is we don't talk about contract needing to be in writing. Contracts can be verbal. They can be something that happens as an agreement between two parties. You don't have to have written it down. But from an IFRS 15 perspective, you still have to analyze the terms and conditions that actually fit into that contract. The second one is equally important, and this will have an impact to an extent on banks. You cannot or should not, you won't get away with writing two contracts in order to get two different outcomes. What you've got to do, but part of the same single package. What IFRS 15 says is if you have negotiated the terms of a contract as a single package, even if you write the contract down as two different contracts, you need to combine them. You need to pull them together and consider them as a single one. And that's particularly important where there is linked consideration involved. So I sell you one thing and we agree on a price. And a good example here might be that I agree to sell you something over the next 5 years. I'm going to deliver the same product to you for 5 years. Okay. But what I want is a big upfront payment and lots of small payments for the following delivery. If I then write that down as 2 contracts, the first one is for the delivery of the very first item and carries a high price. The second contract is for the delivery of all the subsequent items at a much lower price. IFRS 15 says I must combine those 2 contracts together. I must work out what the average price is for all of the products I'm delivering. Okay, and then I must actually apply that average price to each successive delivery of the product. And so that becomes quite important in things like, for example, cell phones, where very often I can go into a cell phone shop, I can buy a cell phone at a vastly reduced price in return for the fact that I will take a 2-year contract for that cell phone. Okay. Have I really paid a vastly reduced price for the cell phone? No, because I've actually got a single contract that has got 2 elements to it. The first one is I underpay for one part, the cell phone. I underpay on day 1. The second part is I overpay for the next 2 years for the service I get. It's a single contract. I need to look at the pricing of that as a single contract because they're written in lieu of each other. They're written in contemplation of each other. And then, of course, on the other side, I've got a separate contract. I need to, the other side is contract modifications. If a contract is updated over time, I need to simply consider whether or not over time I have a new contract at each point, or whether in fact the contract is simply a modification. And this talks about how I deal with that. So not too complicated. The combined contracts is one that does have an impact, as I said, in banking. Very often you find in banking there's a whole family of deals that are put together in order to understand a particular thing. You might, for example, have just a basic current account in banking where you pay an annual fee. And the bank looks at the annual fee and says, well, the annual fee is for free money. I can put it straight in my pocket. I've earned that money the moment you pay it because it's non-redeemable, it's non-claimable, etc., etc. But the bank is also providing you with free bank services for a year as a consequence of this fee you pay up front. That's a combined contract. I need to look at the 2 things together. So these are some, we're starting to get into some of the complications, but that's a very simple one at the moment. This one should be easy. This one shouldn't be too big an issue for banks. You.
But with this example, we have upfront payments of, I don't know, some fees out of a loan. You get 100 a loan to a customer, and from that loan you deduct, I don't know, 1, which is a fee for the credit institution of providing you that loan. Should we kept it on our balance sheet or not? Because as a for supervisors, it is an exposure.
Yep.
Should we put a risk weight on it or not? Because it is already paid. The money went, or customer never received that money. And how should we account for that?
So I think there are a couple of questions in there and a couple of really important issues in there. The first one is, it's very often the case, and you find it as you move down the sort of scale of client size, you find that fee tends to be bigger relative to the size of the actual loan. So what you've got is up front here, you've got a simple thing. I've advanced you a loan. As part of that loan, I have charged you a certain amount, and I've deducted that amount from the loan. Okay. The first question that you ask under IFRS 9 and IFRS 15 is, was there actually a service provided? So did I do something to earn that fee? Now, in some circumstances, I may have done something to earn the fee, so I might actually have provided you with a value-add service like a credit card or a checkbook or something like that. That's what I earned as part of the fee. But in many, many circumstances, you argue that, in fact, that fee is not for a service provided at all. It's simply an initiation fee that the bank charges you. If it's an initiation fee, because it is not for a service, from an IASB perspective, we consider that to be interest. So essentially what you would do is you would treat that as a higher interest amount. The amount that I have actually advanced you is not the 100. but I've advanced you 90, and I will recover the extra amount as interest over the period of time. I'll treat it as interest because there isn't an underlying fee. If, on the other hand, we think there is an underlying fee, so on the other hand, we think, in fact, what's happened is you really have provided a service, you get into IFRS 15, and IFRS 15 says I must then recognize the service only when I deliver the service. And so essentially I have a creditor. I have an unearned amount if I have not yet delivered the service. So if the service is to provide you with a particular thing over 12 months, then I can only recognize that fee over the 12 months. And in that case, it is going to appear on your balance sheet. You're going to see the separate amount on your balance sheet. You're going to gross up your asset and gross up the liability. On the risk weighting question, I find that a little bit more difficult, to be honest. I think from the risk weighting of the asset, I think you probably would need to think of that asset and liability as being the same thing and combine them and not look at it from a risk-weighted perspective. Because it's the same client, same person. Essentially what I've got is I've got a bigger asset and I've got a liability from the same client for the same amount. There is a set-off type of situation that occurs there. But I think that probably looks to the way you would also treat other assets and liabilities for services yet to be provided. I don't know if that helps much. And maybe I'll think about this one as we walk through the process and just see if there's a different way to think about it.
It's a tricky one because, for example, you can have somebody who has a prepayment and then you deduct from his this fee. And then you should account for it not immediately.
I agree. I think the difficulty, the delay in the accounting process sometimes gives rise to an asset or a liability that, from the perspective of the fact that you've already received the cash, means there's no inherent risk in that asset or liability. And if that's the case, you may need to think about the risk weighting of it. So it does create a difficulty. Yes.
Hello. I would like just to add another example to the question from the colleague before. Well, there are a lot of cases in the practice. I think that in all countries this can be seen, where a loan is offered to a customer from a bank, and in addition of taking a simple consumer loan, you get a lot of free services from the bank, like no fee for the first year of usage of internet banking, or no fee for the first year of usage of phone banking, mobile banking, or things like that, which are clearly, according to my opinion, separate services, separate from the loan, from the provision of the loan, from the origination of the loan. I know what's the case in Macedonia, that these separate services are not separated in the bank's accounts and are not recognized as separate services, and there is no deferral or recognition of separate fee income for these separate services. So I just want to hear what's your opinion, whether this combined document, according to IFRS 15, when it's going to become applicable, should be separated and recognized as some portion of the loan provided. Thank you.
And it's a very good example. And if there's one of the underlying concepts in IFRS 15 is a concept of life, if you like. Nothing is free. You don't get anything for free anywhere, anytime. And so essentially in the circumstance you've described, I'm not getting free bank services. I'm paying for those bank services. The way the bank has structured those services is as interest, but it doesn't change the fact that the structure doesn't change the fact that the bank is providing me a service and it is getting remunerated for the service. So in that circumstance, under applying IFRS 15 and IFRS 9, you would have to determine how much of the interest payment is not interest, but is in fact a fee. Now there is an issue, there's an overall issue here of materiality. Is the number likely to be material in the bigger context? But I think there's a good chance that it will be material. And this is one of the issues that's been raised from banks, is that they suddenly started to realize this may have a real impact. Do you want to come back?
Just an additional, how do you see this problem regarding the VAT? Because if you provide a service and it's not a banking service, you should pay a VAT on it. And Nowadays we include it in the effective interest rate, so it's like a loan. You don't pay VAT on it. So by this division between providing, I don't know, free banking, should they pay on it?
And you may just have explained why exactly it is that banks choose this particular mechanism for doing it. Essentially, from the perspective of and the starting point for us is always to say that we don't write IFRS for tax. We write IFRS for accounting purposes. We want to reflect the economics of that particular transaction. Very often a tax man wants to reflect, where we will talk about we want to reflect substance over form. Tax authorities, generally speaking, prefer to represent form over substance. They're looking for the underlying legal agreement. And so I suspect it may raise questions that the tax man comes along and says, well, hang on a second, what's this about? Why are you getting a different outcome? Whether it actually changes the taxability, I'm not sure. But to my mind, in a perfect world, you are delivering a service, you are charging for that service, you're receiving remuneration for the service. It seems to me you should be charging that. But I perhaps don't want to be quoted on that one.
So I have also the question, maybe it is related to the first question of our colleague. This refers to the prepayment option and fee charged in regard with this option. In Georgia, there is usually the case when banks offer this prepayment option, and you can go to the bank and prepay the part of the loan whenever you want for a small fee. But this fee is usually fixed and relates to the amount prepaid, for example, 1% of the prepaid amount. And we discussed whether this fee is part of interest rate or not. So we also discussed whether this fee represented a derivative embedded in the contract, and there we needed to consider whether this fee only somehow is charged for the lost interest, or it is some above the lost interest. And currently we do not have the clear picture of how to account for this prepayment fee, and I just would like to ask your opinion regarding this issue.
I think arguably a prepayment fee, an amount that you pay because you have early repaid, compensates the bank for the fact that what it will very often have done is it will have taken out funding to fund that particular loan. It would have had to secure the duration of the funding or the maturity date of the funding. When you prepay, it's essentially got a problem now that it needs to repay the transaction on the other side. So essentially a prepayment fee like that is usually a fee that relates to lost interest, as I think you've described it. I would be disinclined to describe that as a fee. And the reason why is because a fee should be for a service provided or for a good provided. I'm trying to recover the fact that I've done something for you. And in this circumstance, in fact, what I've done is I've not done something for you. I've terminated or allowed your loan to be terminated early. So I think what you're talking about is an interest amount. And it's to compensate for the fact that I've given you a fixed rate of interest and I'm allowing you out of the contract early.
So this is in the case when this fee is far above the lost interest. So, and there are no changes in interest rate, market interest rates, and this fee may significantly increase the effective interest rate. Even in this case, it is better to include it as an interest.
I think it is better to include it as interest in that circumstance. And I'd be interested to hear if anybody else has got views on this. But my starting point is because there is no service I can attach this to. It's simply a part of a loan arrangement. I'm not providing any other service in this space. What this might do, which is a whole different issue, is it might trigger what we call the SPP&I test under IFRS 9, which we'll talk about tomorrow, because now I have an amount of income that I'm receiving in a financial instrument, because I've now said I'm not in IFRS 15, I'm in IFRS 9. In IFRS 9, I'm receiving an amount of income that does not relate to a reward for time value of money and does not relate to a return of the capital amount that I've lent. And so that might trigger the fact that I fail SPP&I and I have to account for the item at fair value. But that's a different issue. I think what we're talking about here is which standard I'm in. Once I've determined which standard I'm in, I may have an additional complication to think about. Okay, I'm going to ask you guys a quick question then. Let's just move on to the first question here. So what I've got is a company, Northwest Motors, that agrees to deliver a red BMW 318 to a gentleman called Mr. Lucky. Okay, Mr. Lucky is buying a new motor car. The question simply to you is, under IFRS 15, is there a contract with a customer? So, company called Northwest, normal course of business is to sell BMWs. It's selling a BMW to Mr. Lucky. The first one is, if Mr. Lucky is the owner of a company called Southwest Motors, okay, and pays for the purchase by delivery of an identical white BMW, okay, is this a contract under IFRS 9? Second one, Mr. Lucky trades in his one-year-old BMW 318 and pays the difference of the value in cash. So in both cases, 1 and 2, Mr. Lucky is giving a car and getting another car in return. Okay, the third one is the car will only be available for delivery in 12 months. Okay, so we've agreed that I'm going to get the car, but I'm only going to get the car in 12 months' time. Okay, I have to pay nothing at the moment. Mr. Lucky doesn't pay a cent. In 12 months' time, he will receive the car. In 12 months' time, he will pay cash. And then the questions at the bottom here are none of those contracts with customers. Is only 1 and 2 a contract with customers? Is 2 and 3 a contract with customers? Now, what we're going to do is we're going to test these little things in front of you. So the idea is as soon as we start the clock, you press a number anywhere from 1 to 6 in terms of what you think. Okay? We'll give you 10 seconds with the clock counting down over there to see which answer you think is right. Okay, shall we start the clock now? We're starting with an easy one. All right, let's see what we say. Okay, so we've got an exact even split between 1 and 2 above being contracts with customers and 2 and 3 above being contracts with customers. Okay. Number 1, not a contract with customer. Why is 1 not a contract with customer? It's simply an exchange of very like items between 2 people who do this as a business. So I've got 2 car dealers on either side. They've simply exchanged motor cars. There hasn't actually been a transaction. I haven't received anything of new value. So 1 is definitely not a contract with a customer. 2, we had 13% of people say 2, and most of the people at the bottom also said 2, so it looks like we've got about 75% of people saying they think 2 is right. I'm not going to spend too much time on that. Absolutely, 2 is right. I have a contract with a customer. I've sold the customer something. I've received cash. The fact that I've also received a car doesn't matter because this is not about facilitating a transaction. Okay. 3, the car will only be available for delivery in 12 months, no money paid at all. Okay. So we had, what do we have? We had 4% who said 3 was the right answer, and then at the bottom here we had another 34%, so we had about 40%. Okay. Those 40% are right. Okay, in that space. Well, the 34% at the bottom are probably the right ones. A contract comes into existence as soon as you agree to do something. It doesn't matter that nobody's performed yet. That doesn't change the fact of whether you have a contract with a customer. I, as the salesperson, have agreed to do something. You, as the purchaser, have agreed to do something. When we do it is how we deal with the next parts of the test. But in terms of identifying whether I have a contract, yes, I have a contract. Everybody happy with that answer so far? All right, shall we move on? Okay, so we've identified a contract. The second thing, and we already started to do it here amongst us as we were talking through that initial problem, is to identify the performance obligations. What am I trying to do? I'm trying to identify the things that I have promised. And I'm trying specifically to say there might be only one thing, there might be two things, there might be three things. In the example we were talking about, I think we decided there was only one thing. I've promised you money which you can repay early. In your example, I promised you more than one thing. I promised you a loan, and I have promised you free bank services down the line. So the idea of identifying a performance obligation is to identify what the promises are, how many promises there are in a contract. A couple of principles, a couple of rules about identifying those individual things. The customer must be able to benefit from each of the individual goods and services. So they must be able to benefit from the free bank services. They must be able to benefit from the loan. And it can be either together or along with other things that are provided by the vendor, the person selling it. And they must be separable from the other promises. I must be able to pull them out and actually understand that these two things are separable. So again, we come back to your example. I could argue that there are two things. There's a loan, and there's the ability to repay the loan early. But actually, I can't have the ability to repay a loan early without having a loan in the first place. The two are inseparable. They're part of the same thing. But with your one, I've got a loan and I've got free bank services. Those are two things that I can benefit from separately. I can use in different ways. So arguably, those are then separate performance obligations. So my first thing was a contract. My second one is now to identify what I have promised in the contract. So let's get into question 2. Same question. The sales contract includes the sale of a vehicle. Okay, so I'm selling you the vehicle. In addition, I'm giving you a 12-month warranty that the vehicle won't break down when you drive it out the shop. I'm selling a special, one of those Zuti M-class aerodynamic kits that makes the thing look faster than it really is. And I'm giving you a 5-year service plan. 5-year service plan means for the next 5 years, I will service your car for free. Okay. How many separate obligations do I have here? Is the car the only thing I'm selling you? Am I selling you the car and the warranty? Am I selling you the car, the warranty, and the aero kit? The car, the warranty, the aero kit, and the service plan? Or the motor car, the aero kit, and the service plan, excluding the warranty, or just the motor car and the service plan? Okay, we start the vote now. Okay, so we've got a lot of people going for 4. We've got some people going for 3. And I suspect the guy over there who asked the question is the one who's going for 6, the motor car and the service plan only. Because your question is spot on. Okay. Your question is spot on. Is the aero kit separable from the car? Now, most of these cars, when you buy them, it's just a part of the car. You can't actually break it out. You can't separate it out. I think we left that point open. So I think the first point I'd say is that I need to think about whether I can use the aero kit alone. Can I take the aero kit off this car and stick it onto another car? If I can't, then obviously it's part of a single indivisible unit. So we've got some people who said the car only. Most people said the motor car, the warranty, the aero kit, and the service plan. And I think those people are on the right track, but are not correct. Okay. The right answer is actually 5. Okay. And the right answer being 5 is because a warranty is not actually a separate thing you're selling. A warranty simply says the thing I'm selling you will do what I promised you it will do. I need to think about a warranty when I'm determining what my sales price is, but I haven't actually sold you something different. I've simply told you that the thing I sold you will operate the way it is supposed to operate. But certainly for the rest of that, the motor car is definitely a separate thing. The aero kit may or may not be a separate thing, but the aero kit, let's assume for the moment, can be used with another car, can be separated out. And the service plan is definitely a separate thing. Okay, so separate identification of performance obligations, that's the way we think about it. Where does this affect banking? Well, we already talked about a couple of examples in banking where it might actually come in. In merchant banking or investment banking, there are an awful lot more of things that come in and how we actually think about those. Okay, so moving on. Okay, so I've got a contract. I've identified the individual promises in the contract. Now I need to determine the transaction price. Now, sometimes people will say, well, determining the transaction price is easy. You must have agreed what the price is. But actually, determining the price can be very difficult depending on the circumstances. So what are the things that can make it difficult? The first one is if there's variable consideration. So a bank agrees to do the consultation or to do the advisory work on an acquisition. And it says that its consideration will be determined based on some other indicator. So it will get 60% of its fee based on an absolute amount, and 40% of its fee will be determined on the success factor of the transaction. Okay. That means it's got a variable fee. It knows it's receiving 60. It doesn't know whether it's going to receive the further 40. And so under IFRS 15, we apply something where we should call the constraint, which says even though you might expect to receive the full 100, there is the possibility, there's a significant possibility of reversal. And if there's a significant possibility of reversal, you can only recognize the 60. So the transaction price in that circumstance might be the lesser amount. This really comes in a big way with insurance companies, because a lot of insurance companies also have separate asset management services. And asset management services very often say, I will manage your assets for 5 years. I will take 20% of your 5-year return as my fee. Okay. The problem with that is, in the first year, if I have a great stock market performance, I say 20% of that performance is great, it's a big number. But if the stock market drops after that, I will have to give back that fee. The fee will reverse. And so arguably in asset management circumstances, there are very big components of fee that I cannot recognize until very late in the process. And particularly the performance bonus type elements I can't recognize until later. The second thing that affects pricing is financing. If I sell you the BMW today for $100,000, okay, and I get the $100,000 today, then clearly I sold you a BMW for $100,000, easy. If instead I sell you the BMW today, but I say you only have to pay me in 2 years' time, and in 2 years' time you only have to pay me $100,000, is that $100,000 really worth $100,000? No. There's a delay in the time that I'm going to get it. So I need to think about financing. I need to think about whether there's been a prepayment or whether or not there's a late payment in the process. And if there's a difference between the timing of delivering the goods and the timing of getting the money, I need to consider that in the process. Non-cash consideration. How do I think about the value of the thing that I got if it wasn't cash? So remember, one of the examples there was that Mr. Lucky gave his old BMW in. Okay. What is the value of the old BMW? And what the standard says is the value that I need to consider is the fair value of the old BMW. So I need to think about cash consideration. I need to think about the fair value of what I'm getting in return for that. And then payable to the customers. Sometimes I pay the customer money for doing the deal. So I might say, okay, you come and buy something from me. You pay 100. I'll give you a 5 rebate. And I actually physically pay you the 5 as an additional thing. That very often happens in circumstances where people get funding for something. So I get a bank loan for the 100, but I actually only have to pay 95. The way you work it, the bank pays the dealer 100, and the dealer pays back 5 to the client, and the client actually gets to put money in their pocket. Sometimes that happens with things like housing. So you'll buy a house for 100, but the house hasn't got a kitchen in it. And what they'll say is, okay, the kitchen was priced into the 100. You pay me the 100. I'll pay you back 10 in cash, and you can use the 10 in cash to put your own kitchen in. Essentially, you need to take the net amount of those two for calculating or for determining what the transaction price is. So determining the transaction price, not always as easy as it looks. Yes?
The third part, how does it reflect non-cash consideration for banks? If we have an unperforming loan and banks take the collateral, they should book it at fair value or the outstanding amount of net book value, or which amount?
So they should record it at fair value because that's the value at which they're bringing it into their books. Okay. What they may need to consider about fair value in that circumstance is costs to sell. So what you very often find is that a house is worth 100 when I buy it in, but I'm only going to get 80 out of it because I'm going to have to pay certain costs to maintain it, maybe to fix it up a little bit, and then the auction cost for auctioning it. You might also need to consider, and this is a really important one, whether the fair value has in some way been impaired by the process. I did a presentation a couple of months ago on banking in the Caribbean to the East Caribbean Central Bank. And because what you've got in the Caribbean is you've got very small communities, you can't actually sell the house when you take it away. Because nobody will let anybody else live in Joe's house because Joe had his house taken away by the bank. So you can't sell the house. So essentially, it ends up having a fair value of 0 in that circumstance. So you need to be considering the fair value in the specific circumstances you're looking at. Less cost to sell.
But we have a problem. We have problems because the mortgages are due to regulatory rules. Our net book value is really small, and when you take the house, you release the provisions, and in fact, the bank's book profits.
So I guess there are
For
two.
us as a regulator,
There are two issues there, though. I would assume, and this might come back to the different jurisdictions, but I would assume if there's an outstanding loan of 50 and the underlying collateral is worth 100, I bring the collateral in to my books. I would use 50 of the fair value of that collateral to settle the loan, and presumably I have to pay the extra 50 back to the homeowner because the profit is for their account, not for my account.
It depends on the legal way that you get the possession of the house. There are different legal ways. Sometimes you can get a house no matter what was the difference between the selling price and and you own them. And you still own.
Okay, then essentially what you need to do is you need to take it into the bank asset. It arrives in your books at its fair value, which I think then does create the problem you're talking about. And so that certainly from a pure accounting perspective is the correct accounting. Whether that means that afterwards you need to put some kind of additional capital risk weighting on an asset like that, because an asset like that is not going to be easy to realize the value of, whether you do it by rental or by sale. Okay. This is just the constraint. So we've talked about the constraint already, so I'll bounce straight into the next question. Okay. So here's my next question. Normal purchase price of a BMW is 100,000. So remember, we're still dealing with the same thing. I've sold the BMW to Mr. Lucky. Mr. Lucky has exchanged his car for the BMW. The normal price of the BMW is 100,000. Mr. Lucky traded in his second-hand car. And the second-hand car has a value in the market of 45,000. Okay. However, Mr. Lucky agreed that he would give up his car, plus he would give 60,000 in cash. Okay, so he's giving up the value of the car and 60,000 in cash. Northwest Motors immediately takes that car, puts it in their showroom at a price of 50,000. Okay, so essentially they paid Mr. Lucky 40,000 for the car. The car was worth 45,000. Okay, and they put it into their books. They put it into onto their floor at a price of 50,000. What is the transaction price in this circumstance? Is it 60,000, being the cash price, the amount of cash they actually received? Is it 100,000, being the normal purchase price for this car? Is it 105,000? Being the 60,000 they received plus the 45,000 value on the car, or 110,000, being the 60,000 they received plus 50,000, which is the sales price they paid on the car. Let's go, counting down. Okay. All right, so obviously the questions are getting easier because we're starting to get them right. Okay. So the important point for 52% of people, so what is it? It's the cash I received, 60,000, plus it is the value of the car, 45,000. The fact that I managed to confuse Mr. Lucky into actually selling the car to me for 40,000, or allowing me to ascribe a value to the car of 40,000, doesn't change what the real value of the car is, which is 45,000. You can see I've had bad experiences with second-hand car salesmen. Okay, the fact that I'm going to put the car on my floor for 50,000 doesn't change the fact that the value of the car is 45,000. Why important for banks? The first question we already got over here was about the idea of those properties that are coming in. But also very often, banks engage in traded transactions. I give you something in return for the something you're giving me. If I'm looking at underwriting fees, I'm getting shares in return for a particular service I'm offering. In each of those circumstances, what I've got to consider is what is the fair value of the consideration I'm getting. What is the fair value of those shares? It is irrelevant what I've written in the contract. The contract tells me, the contract is a guide to the transaction price, but the real transaction price when it is something other than cash is the fair value of the thing that we are exchanging. Yeah.
What is this transaction price used for? Because on the revenue side you will have only what, 45.
Hold that thought. We're getting to that in a moment. So we'll talk about it in a second. So the important point here, though, is that's the principle. What we've done, we've gone through 3 processes now. We've identified a contract. We've identified the promises that we have made within the contract. And now we've determined what the transaction price is. So we move on to the next step, which is to allocate the price. So what I've got to do here is I've got to determine how much of this price that we've calculated is allocated to each of the individual promises I made. So remember, in all the different things we've talked about, in the classic example we've got is the one you talked about with the loan and the free bank services. So in the loan and the free bank services, I identified that there were 2 things I was delivering. The one thing I was delivering was a loan. The second thing I was delivering was the bank services. The fee I was receiving, the transaction price, is the interest I expect to receive because I've correlated everything to the interest. Now I've got to determine how much of that interest, how much of that part actually relates to the bank charges and how much of it is really interest. Okay, so I've got to divide it up into 2 parts. Now, if for the moment I assume that I've taken a $10,000 loan and the $10,000 is for a year only and I pay for everything at the end, I actually don't really have much of a problem with it because what I've got is my interest is going to be the same. In fact, I pay interest only every month. The interest amount is going to be exactly the same every month. Let's say it's 10%, so it's whatever that is. I'm going to receive exactly the same amount of interest over 12 months. And the service I'm delivering, the free bank services, is also every month. But assume for the moment that in the particular transaction you're talking about, it's actually a loan where I'm paying interest and capital. So I'm paying off the loan over the period of the 12 months or over the period of 10 years. What's going to happen to the interest? It gets less and less and less, doesn't it? Starts at a very high amount, goes to a very low amount at the end. What happens to the service? Stays constant. So in that circumstance, I actually have to think about, firstly, splitting out and determining how much of the interest, how much of the amount that I've called interest is actually for the service. I've got to separate it out, and that piece I've got to spread evenly over the 10 years. The interest piece, the part that I've identified as interest, I've got to recognize on that declining scale over time. So the standard just tells you about how you should do it, and it starts by saying, look at the individual pricing of those things. So how much would I charge for those bank services if they weren't free? How much interest would I have charged that client if it wasn't free? And if I wasn't giving free bank services as well. If I have got that, if I've got standalone prices, it's very easy. I simply price the one service, price the interest, and then determine if I've managed to get a premium or a discount on top of that. So what I might have done is I might have said, all right, I would normally charge you 1,000 for the services and 10,000 for the interest, so that's 11,000. If I'm charging 11,000, easy. I just give the 1,000 for the services, the 10,000 for the interest. But if I'm in fact charge you 10,500, I've got to do a ratio thing to say, all right, I've given you about a little bit less than a 5% discount. I've given you a little bit less than a 5% discount. I apply the discount to both items equally. Okay. Sometimes I'm not going to be able to do that. Sometimes I'm going to have to look at a residual basis. I'm going to have to say, all right, I never actually sell services at all. Okay. So what would I sell the loan for if I didn't include the services? So what I do is I price the one thing and I determine the price of the other by assumption. If that's what the price is of the interest, all the rest of the money I'm getting must be for the free bank services. You're starting to see why, although this doesn't impact big numbers in banks, it may be quite complicated for banks to figure out how to do that breakup between the two different items. It may actually have complexity, and particularly on transactions where you agree a global price on something without necessarily having thought about all the different elements that you're actually providing the client within that process. All right, so let's have a look and see how this would work then. So back to our BMW example. All right. What I've done here is I normally sell the BMWs with service plans, and I never sell service plans on their own. Okay. I have a look at the example and I say, all right, the service, the car and the plan with no extras would normally be 95,000. So that's how much the car plus the plan costs. I charge 5,000 extra for the aero kit, so that's fine. I've got the aero kit. So I've determined 95,000 plus 5,000 for the aero kit. I sell the same cars, let's say to Avis, without service plans, and I sell those for 85,000. Okay. I have determined in this particular example that my sales price for all of this is 110,000. So the actual amount I'm getting is 110,000. That's a slight deviation from the example we were thinking about earlier, but that was just to make the maths on this slide easier. So I'm selling it for 110,000. That's my price. How do I allocate the price to each of those individual pieces? Okay. So I can say I either allocate everything to the motor car. There's a whole 110,000. That's easy. Or I can say that the motor car is worth 85,000, taken from the price that I sell to people without the car in. The aero kit is 5,000. That seems logical. The service plan is the difference between 95 and 85, so 10,000. And I've got 10,000 of extra profit. I've actually managed to persuade this guy to pay too much for the car. So I've got 10,000 of extra profit. Second example. Third example, I simply add the service plan into the motor car because you can't have a service plan without a car. You can't have a car without a service plan. The fourth example is I have taken the profit margin and said I actually need to spread the profit margin into each of the individual items. And for the moment, let's exclude the fifth example. I'll explain it when we finish. So you've got to choose between 1, 2, 3, and 4. Okay. Shall we start? 1, 2, 3, and 4. Okay. So what do we got? We've got 57% going with this example here. Extra profit is recognized. What is it? 22% with that one. Looks like the biggest group here would say that I've actually got an extra profit and I need to take that extra profit and separate it out. I can't allocate it to anything. It's a reasonable answer. It makes absolute sense because what you're saying is my normal sale would be 100,000. The extra 10,000 I can put in my pocket immediately. Okay. What IFRS 15 says in this circumstance is any extra profit is like any other profit that I make. I've got to allocate it to the individual performance obligations to be recognized when I deliver on the performance obligations. So 2 and 3, unfortunately, immediately sort of fall out. Okay, so those two are out of the equation. For those of you who went for 4, the remaining people, that would be the right answer. Why? What have I got to do here? I've got to recognize what my deliveries are. Now, we said at the beginning, the things that I'm delivering are a motor car, an aero kit, and a service plan. So I must allocate it to those three. I allocate it to those three, firstly on the basis of standalone. So standalone here would have been 85,000. Standalone here would have been 5,000. Standalone here would have been 10,000. But then what I've got to do is I've got to take my additional profit margin and allocate it to each of those individual items in proportion to those underlying items. So I've simply taken the extra 10% and applied it to each of those. Okay. The reason why we don't allow that profit margin will become clear in a second. So I think let's move on. All right. So the point is, what have I done all of this for? What have I done? I've identified a contract. I've identified the promises I've made in the contract. I've identified what the transaction price is, and then I've allocated that transaction price to the individual promises. So the final step in the revenue contract, the revenue standard, is to say I can only recognize revenue when I perform. What do I mean by that? I cannot recognize revenue on something I have not yet done. I must only recognize revenue when I've actually performed under the process. So that's easy. If I'm selling a cell phone under contract, okay, when I give you the cell phone, I have already performed. That part of the performance is done. It's finished. I don't have to do anything more. You have your cell phone. You can take your cell phone and walk away. But for the coverage part of the contract, I will only perform over the 2 years or whatever the period is. So what I would do in that circumstance is I would recognize the revenue I have assigned to the cell phone immediately that I deliver the cell phone. I would recognize the revenue that I assign to the contract, to the coverage, over 24 months. And the idea being behind that, the logic behind that, is that I only have revenue when I have done what I promised to do. So all of the steps we've walked through here are about identifying when I actually do it. And to an extent, we did it when we talked about the loan with the free bank services. What did we say with a loan and free bank services? Well, we said that the loan, I am providing you with the benefit of the money over a period that declines in value. I recognize more interest at the beginning, less interest at the end. The bank services, I'm providing you in an even line across the middle. I only recognize the revenue as I provide each new month's worth of services. So essentially, I'm just saying, need to recognize what those underlyings are. I need to recognize what the value of those underlyings are so that I can determine at what point in time I have actually delivered them to you. And that's then why this is important. The profit margin, if I were to recognize a profit margin as a separate line, when do I actually recognize revenue on the profit margin? When does that revenue come in? Do I do it immediately? Do I do it in line with when I sold the car? Do I do it in line with when I sold the aero kit? Do I do it in line with when I provided the services? Provided the actual service on the car? So the only way to do it is to allocate it out so I know when to recognize the revenue. That's it.
I must say that I don't understand this because you provided the car immediately. The customer starts to consume it, so the service is provided there. I understand for the service plan that you can divide it during a certain period of time. Aero kit is already on the car. So, and by me selling you the car, this is old-fashioned bookkeeping. I book the profit margin for the aero kit and the car immediately.
Yep.
The service plan, I can divide it.
And that's exactly what this provides you with. So what I'm going to do here is, remember I said I allocated these prices. When did I deliver the car? Immediately. What is my revenue? 93,500. When did I deliver the aero kit? Immediately. So I recognize the revenue immediately. So on day one of this transaction, I'll recognize 99,000 of revenue. Okay, that's my revenue in the top line, and whatever the costs are that are associated with that. But when do I deliver the services? only over time as I perform the services. And so I can't recognize this 11,000 immediately because I haven't actually done the work. I haven't serviced the car. Does that make sense to you?
Let's say that I didn't understand what you say. 99,000. What is the right answer now? D or E?
Okay, so essentially, what I'm going to do is I'm selling you two things. I'm selling you the car. I recognize 93,500 of revenue. I'm also selling you the aero kit, and you drive out with the aero kit. So the extra 5,500 for the aero kit is also recognized immediately. And I'm simply then adding these two together. So that plus that is 99,000. So on the first day, when you drive out the car, you're taking both of those things. And that's the revenue I will recognize on the first day.
P&L you will have 9,000.
In the P&L, I will have 99,000 with whatever the cost is. So I think this is simply a way, and this mechanism then is the most important mechanism because of the next step. Because the next step is essentially saying, now when do I recognize the revenue? And there are two types of revenue I can recognize. I can recognize point-in-time revenue. I've actually done something for you right now. Or I can recognize revenue over time. Essentially what I'm doing is I'm satisfying something over time. Now, the services in this case are also point in time. It's just a different point in time. Whenever I actually perform the service, whenever I do whatever it takes to get the car going, put the oil in or whatever, at that point I have a point in time delivery and I will recognize the revenue associated with that point in time. But if, for example, I was providing insurance revenue on this, insurance coverage, what I essentially said is I will charge you for insurance on this. And assuming for the moment that insurance was in this standard, which it is not, then what I'd essentially do is I'd say, well, that's recognized over time. I provide you coverage every day that you drive in the car, every minute that you drive in the car. And so I'd recognize the revenue spread over time. And examples of over time are things like royalties, things like security services, any of those types of things are actually recognized over time rather than at a point in time. But the principle of the standard is I identify the price that relates to that performance obligation and then only recognize that performance obligation when I perform, when I have actually done the thing. And in this case, I've done the thing at specific points in time. Yes?
Yes, so in the case of mobile, so at the beginning you were saying it's at a loss, yes, and you would get the revenues throughout 3 years contract. So you split the revenues that you link to the code that you were getting in the future, and the rest which is linked to the service you provide, and you discount it and you recognize it at the beginning.
Absolutely. So this is a really important one. And the mobile phone one is the mobile phone industry is the industry that's been particularly upset with the IASB on this. Because what mobile phone companies said is that they do sell the phones at a loss. And so they were actually very comfortable to recognize a day one loss. And then on coverage, they would show lots of profits because they were actually showing a higher profit. What the IASB said is nonsense. Nobody is in a business to sell something for a loss. What you're doing is you're undercharging on one and overcharging on the other. So exactly as you said, what a mobile company now has to do is calculate what the present value is of everything that they're going to deliver. Okay. And then they need to assign the price to the phone and assign the price to the coverage. And then the moment they deliver the phone, recognize the revenue on the phone, which will be higher than what the price was of the phone, because there's a cross-subsidy happening. And then as they deliver coverage, they recognize the price that they've determined, or they recognize the revenue they've determined for the coverage, which will be lower than the price they've determined for the coverage. Now, one of the interesting things on this one, just to give you an idea, when I talk about the fact that banks might still be catching up on this, a lot of the telecom companies have already changed their invoices. Their invoices used to say, phone, I got an Apple iPhone for £100, and then I pay £60 a month for my coverage. Now what it says is I paid a down payment on my phone of £50, or of £100, and my bill is split every month between £30 for coverage and £20 for the phone. They've needed to do that because one of the worst things that can possibly happen to any company when they have a change in accounting standards is to take profit they have not yet recognized and put it into opening retained income on the first day, because then you don't get bonuses on those profits. They sort of go straight from not being recognized to having already been recognized. And so they're already starting to change their billing. They're already starting to change their accounting in anticipation of what is coming. I say this would be the reservation I have with banks, is we haven't got there yet. I'm actually going to stop there. I've actually covered the brunt of this. Is the 5 steps of the way the thing works. Yes, sir.
I just want to ask you to clarify one moment. In previous we were talking about the car and the service, where we recognize revenue for car at the point of sale and then recognize revenue for service over the period. Here we have the telephone and we have also this service provided, but now we are not recognizing the telephone revenue at the point of sale. So what is the distinction between these two? So just to clarify.
Absolutely. No. So I think under current processes, so right now under the old standard, they do not recognize the revenue when they sell the phone. Under IFRS 15, they will have to recognize the revenue when they... So essentially what it is exactly the same now. It does mean that some companies like BMW are recognizing revenue later than they used to. And some companies like the cell phone companies are recognizing revenue earlier than they used to. But essentially the change is that now it's the same principle all the way through.
How revenues should be recognized if the service may be provided or may not be provided? For example, with those service of the car, that the client may come to the seller and say, make him twice because there is each year it comes for the service and maybe additional service because something goes wrong. And the other example is, for example, medicine, that people may be ill twice a year, none during the coverage period, or 5 times. So should be revenue recognized something like on the day by day, by percentage, or if the person comes with the service to be provided?
So essentially, and it's a very good question, but let me split the answer up into 2 things. The first thing is, if I think about the medical example, and even think about the motor car example, essentially what you're providing is an insurance service. Because what you're saying is there's a risk you might not get sick, and then you're paying me money for nothing. There's a risk you might get sick 10 times, in which case I'm giving you services for nothing. That's insurance. So the starting point would be you need to consider whether or not the products you're talking about are insurance. The second part to this, though, is our insurance standard says if the entity providing what is insurance in this circumstance will satisfy its obligation by doing something instead of paying something, it can choose not to be in the insurance standard, can step outside of the standard. And we call it what we call fixed fee service. So essentially I can decide in that circumstance only if I am the company doing the service on the car, or I am the company doing the operations, doing the medical. In that circumstance, I could choose to be in the revenue standard. If I choose to be in the revenue standard says I must estimate how much I expect people will use that service. So I might determine that some people will use it 0 times, some people will use it 3 times. I estimate that the average usage is 1.5 times. Then what I'm going to do is I'm only going to recognize that proportion of the revenue each time somebody uses it. And if I change my estimation, I must change my numbers. So I must do a cumulative catch-up. So it becomes very much like insurance accounting. I'm trying to estimate how many claims I'm going to get, and then I'm assigning the revenue to each of those estimated claims. Each time a person comes, I won't show a full amount, I'll show a proportion of the amount. So, I think we need a microphone for you on your own.
I must say that I don't understand with this, with the telephone companies, because you made a loss on the sale of a mobile phone, and you will earn a monthly installment. Why don't you deduct this loss on a phone on a monthly basis during the, I don't know, 2 years' time? So your profit margin will be the same every month.
Because you've delivered the phone.
I delivered, but
You've already delivered the phone. You don't have to do anything
can return
more.
the phone
Okay, so
and not pay.
have a look at the contracts. Normally the customer can't.
How,
Normally once the customer's got the phone, they've got the phone. They can't give it back. It is now the customer's phone, and they have to keep paying for the 2 years. I would love a contract where I could return the phone, because then every 6 months I can hand in my old iPhone and get a new iPhone.
in our country, they can return the phone. They have some penalties, but they can return the phone. Okay.
So you need to think about that. I think we'll stop there, yes? And then we can catch up at tea time.